welcome. So now what we are discussing today, what we are talking about is what we call deep and what shallow corrective wave. What we are discussing is what deep and what shallow corrective wave. So like I said when market is making a lower low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, a higher high, a lower low. So now, like this, now we said this is our lower low, our lower high. This is our lower low, our lower high. Now, this first leg here that happened here within this range, this first leg you are seeing here is what we call a shallow corrective wave. This first leg you are seeing here is what we call a shallow corrective wave. This first leg here is what we call shallow corrective wave. So price, most times price can use either the internal liquidity or support turn resistance to form this shallow corrective wave. So the first thing is, after forming this shallow corrective wave, it must, before this shallow corrective wave will become a major liquidity, it must have what? Some rules. It must have what? Characteristics of what? Our major liquidity. If it don't have that characteristics of major liquidity, anytime market break this what? Shallow corrective wave, we call it what? A fake break of structure. We call it what? A fake break of structure. That means market what? Trap some buyers. Market trap some buyers. So people will be looking to join the buy here. People will be looking to join the buy here. But you already, because you have learned about structure and liquidity, but we have not gone into the liquidity. Now, since we have learned about structure, you will know what it will do. Why it will what? It will give us what? A lower low. Why it will what? Give us a lower low. So this is what we call a shallow corrective wave. That means the range didn't give what? Enough power. This lower high did not have what? Enough power. So most times this lower high or this shallow corrective wave, it do have what we call a weak high most times. Though it can have a strong rejection sometimes, but it's still what? If you don't have what? The characteristics of major liquidity, it's still what? A fake break of structure. So the major character, that major liquidity or major lower high, because all these external liquidities, the lower lows, since we are on downtrend, are our what? Our external liquidity. That is the one that we are looking for. While the lower high are our what? Major liquidity. So there are some rules that govern this what? Major liquidity. For us to call a lower high a major liquidity, there are some rules. So anytime market break a major liquidity, we don't think twice of what? Saying that this is what? A BMS. We don't think twice of saying that this is what? A BMS. We don't what? Think twice of saying that this is what? A BMS. So a BMS is what? A BMS, even if it break it with what? 1 pips. Even if it break it with what? With 1 pips. Note that. And note this. If you are watching, let's say, other bad mentorship, I do miss it. What I will teach you first might be what I will teach them last, or I might teach them structure first. Then when it's time for liquidity, I will teach them point of interest. So I don't miss it. That is one thing you have to understand. I do miss it. So, but everything is what? Falling into place. Everyone use the same pattern as far as we are under my what? Mentorship. So that is that. Now, this is weak rejection or weak high. So why this? Why this? Now, all weak rejection are not weak high. Now you know that. We have not talked about weak high before. What we have been discussing is what? Strong rejection and weak what? Rejection. We have been talking about weak rejection and what? Strong rejection. So weak high, all weak high are not what? All weak rejection are not what? Weak high. When we come to liquidity will define that for us. We know if liquidity will be able to define that for us or not. So, and liquidity will perfect many things that we need to what? Know when time for liquidity comes. Now, this is a lower low. This is a lower high. A shallow corrective wave. A shallow corrective wave plus deep corrective wave. You will notice that all these are what? Deep corrective wave. A deep corrective wave. It gave a good move to the former range. A deep corrective wave. It gave a good move to the former range. a deep corrective wave. So a shallow corrective wave plus a deep corrective wave is what we call a complex structure. That means complex corrective wave. This is now a complex corrective wave. This is what complex corrective wave. This is the idea of what structure, and this is the what foundation of what structure. So once you're able to hold this, you are good with what wave structure. Then other things will fall into place. Something like liquidity and what point of interest. So that is that about what. So now you will notice that what head price here was internal structure, and the internal structure head price, and this high, the high that it had, created what? A weak high, a weak rejection. It created what? A weak rejection. Since this is a weak rejection, that is a what? A shallow corrective wave. That is what? A shallow corrective wave. This is where we had what? A break of structure to the downside. Since we are on downtrend, since we are on downtrend, we are on downtrend. On downtrend. A strong rejection. You can easily see it. Strong rejection. That means it do something like V pattern. Strong rejection. V pattern. Weak rejection. So after weak rejection, look at what price did. Price did relate to RTO to the former range. Then take it as what normal ICT total soup setup. Then sold off. A weak rejection. A weak rejection. So market always seems to what? Take out a weak rejection. So after that weak rejection, you notice now this is our what? This is now our what? Our shallow corrective wave. Our shallow corrective wave. So after a shallow corrective wave, market form what? A deep corrective wave. Market form what? A deep corrective wave. So if price would have sell from here to continue the downside, this is where price would have what? Sold from. This is where price would have what? Sold from. And there's what? There are some rules about liquidity. If this high is the high that market will take before you start looking for a sell, you will understand when we're talking about liquidity. And this is our point of interest. So what will make you not to take this sell? We are on downtrend. The major concern since we are on downtrend, once you understand order flow, a major thing you do is this. Once you're able to understand order flow, the major thing you do is this. You follow order flow. Forget about some little buy move that is inside. So if, let's say, for example, you take this sell from here. So after taking this sell, based on what we learn about liquidity, now you're able to take out profit around this area before market start buying. We are not talking about hedging. So don't think about that yet. So now market start buying. Boom. Market bought up to this extent. You know it will sell a little. So now this is the only buy move you are able to take. In this buy move, you are able to take this buy move. You already know now, since it has filled this point of interest, where price will go to, which is this weak high. So this weak high now become your target. Not only that weak high, the high that holds that weak high, which is this high. So two of them are your main target now. So once market take it out, since now you know that market will take this high out as what in terms of liquidity, you know it will not take this one out based on what? Major liquidity. So if this is major liquidity, market will not take it out. So that means your point of interest is above from here, from this high to this recent high. This is your what? Point of interest. So this is where you will look for sell to continue the sell move. So you already have this confidence that this is the only area you will sell. And in our point of interest, there are some what? Rules or what that govern point of what? Interest. So that point of interest, particular point of interest, the one that price present around the primary point of what? Interest. That is the we call it, there's what we call when we talking about point of interest. So around this area, there are some what rules that govern this area that you use to take this sell to continue the downtrend till what you take out external liquidity. If you're a swing trader, you enter from that high. This is where you till market take out this low, you will not take out your profit. If you're a scalper, you enter from that high, you scalp later up to this area. You are done with either 30 pips or 50 pips. Now market give a little corrective way to the upside. You take another sell to this low up to this next liquidity. Now you are out of the move. Let's say you scalp a little sell move here, but you know that this one that is from here will become liquidity. Now market can come again. You take another sell based on scalper. That is how you trade as a scalper or a day trader or intraday trader. You don't hold trade long term. But if you are a swing trader or intraday trader, so once you're able to enter from here, let's say you did not enter around this area, or let's say you did not enter this area, you wait for a little minor break of structure, you little confirmation, then you enter around this area, you hold your trade till what your target is reached. Once your target is reached, now you are out. You wait for market to what present another setup on this pair. So you don't trade always because you're what a swing trader. A swing trader is different from what a scalper. You must firstly understand the type of trader you are. Firstly, what you must understand the type of trader that you are. So this is what we call a weak high. So weak high plus minor or shallow corrective wave, and deep corrective wave forms what we call a complex structure or a complex corrective wave. So it has two things inside. It has the what shallow and it has the deep. So it becomes what a complex. It becomes what a complex. So why others are saying that this is what now a BMS. So they are saying that market break a structure high. So since market break a structure high for them, what they are doing here is they will be looking now, waiting for RTO according to smart money. RTO to what point of what interest. So they will wait, they will what come back to this area. So around that area, they will look for buy. Market will trap them in first. Market must surely do that to them. And there are sometimes other block can be used as what liquidity. So those ones that you are expecting market to respect, that the one that always fail. And when we talking about liquidity, you will understand the reason. Now, market will first trap them in. It will give them a little hope to enter. So once market get to their point of interest, they will go to like M1, and M1 will give them a fake BMS again. M1 will give them a fake BMS because they did not understand the real idea of how liquidity works. Now, after that minor BMS, M1 will allow them to enter to be in 1 pips or 2 pips profit. So once they enter in profit, what market will do is this: it will come down a little. When it come down, people that don't have patience will add more position to the buy move. They will add more position. They don't know that it will sell. They will add more position. The market will still buy a little to take this little high here. After taking it as liquidity, as market sell, market has not, as it's selling, this is their low that break structure. Market has not yet taken that low. So as it's selling now, they think that, okay, this market is trying to play with us. It will continue buying. So they will look for another buy opportunity here. They will enter up to 2 times here. So after market know that it has trapped them enough, or it has done enough time to them, boom, it will use enough speed to drop down. So after dropping, as it's dropping, because they have entered up to 3 position, so they don't want to lose more. So they are trying to like allow price will retrace back for where what market will do now is this: market will continue selling, while they will continue adjusting their stop loss later. It will sell, it will buy. So after they adjust their stop loss almost below this low, almost to this low, market will buy a little again to give them a little hope. So they will add another position. They will say, if market get to this sell buy entry that we took here, we will close the position. Before market get to that entry, they have already entered to 2 entry, so that the last buy move will be able to mitigate the loss in trade they are holding here. Market will sell more again. So they can easily blow their account without understanding. And market will keep them frustrated. And market don't care about you. You being profitable or not profitable, they don't care. So that is just their major agenda. So they don't care about you. So that is that. So this is what we call a weak high. Now let's look at gold. Another example which I saw on gold. Now from here we have a minor break of structure here. Though this is okay. So we have a minor break of structure here. Since we have a minor break of structure, market create now a deep corrective wave. It creates a lower low. After a lower low, just like what we saw on NEU, that is New Zealand against US dollar. Sorry. Now, it gave a shallow corrective wave being obeyed or being held by internal liquidity. After that, it creates a lower low again. Now, it creates a lower low since I know that this is now a weak rejection. This is weak rejection. It's not only a weak rejection, it's also what? A shallow corrective wave. It's also a shallow corrective wave. Now, this high that formed here happens to have what? Characteristics of what? A major liquidity. So if market now, for example, take this high, that means once market take this high, that means this next high is inevitable. Market must surely what? Take it. Market must surely take it. It must surely rate this very high. That's how market works. This is the main idea of understanding structure. This is the main idea of what understanding structure or trading perfect structure. Or trading what perfect structure. So now this is our lower low. So here is shallow corrective wave plus what? Complex corrective plus deep corrective wave, making it what? A complex corrective wave. So this is our complex corrective wave. So this is the idea of structure. This is how what we read structure. So this is complex, deep, and shallow corrective wave together. These are the major type of pullback we do have. These are the major type of what pullback we do have in structure. So why these ones you are seeing here? Major liquidity. Major liquidity are the one that we are not expecting market to read. You should know that major liquidity. Why the external liquidity are the one that we are expecting market to read. Why the external liquidity are the one that we are expecting market to read. This is the last range. This is the last range we have. This is what we have BMS to the upside. So after BMS, market start creating range structure. Now after the range structure, is creating what? A deep corrective wave here. So inside the deep corrective wave, that's where we are seeing all these things. So it might come now to what? SC candle. It might now come to what? SC candle before buying or break that low. So once it break that low, since gold is on downtrend, you should take it from daily time frame. You will know that you're on downtrend. So if you break it, now we continue again. That means you're what? Our next external liquidity is this low. Is this low. So we seek for this low again. That's how we trade structure. That's how we create structure. And that is the rule of what structure. This is the main idea of what complex, deep, and what shallow pullback in structure. So in structure, just like I said, so our next class, we will talk about characteristics of what a major structure. We are finishing everything about structure this month. Characteristics of what a major structure. So once we are done with that characteristics of what a major structure, then we can easily go to what our next agenda, which is what either point of interest or liquidity, depending on what on me. So that is that. You understand what we call range structure. The range structure is when market give a pullback, a lower high, a lower low, it creates what a little range without giving a deep pullback into the range. So after the range structure, in range structure, it can have deep, complex, or shallow corrective wave within it. After that, boom, it creates a higher high. Now you know that this is a BMS based on what? The idea of what? Structure. Now it give what? A deep pullback into the range, then give a lower low again. You continue based on higher time frame structure or based on higher time frame order flow till market is what? Market violates your major high. So once market violates a major high, which is this, like this high, now what you expect market to form is what? A higher low. A higher low to join what? The trend to make a higher high. This is your idea. So you must understand your higher time frame, which is what we call time frame difference. So So you understand higher time frame, what price we do or what price is doing in higher time frame. Then you, as a scalper, you can come to lower time frame to trade in line with it. If you're not a scalper, you're a swing trader. You join the trend. You only what you don't trade always as what a swing trader. So if you're a swing trader on this, let's say on this time frame we are now, some major move that you can easily catch. These are one. You catch this buy. Let's say you catch this buy again. You catch, you cut this sell. You cut this. You don't trade always. You trade less either two times or on one particular pair, either twice or once in a what in a pair. So you cut this again. You cut this. This is for what either what intraday trader or swing trader. So these are the major moves that you are catching, or maybe you cut from point of interest, which way when we'll be entering weekly commentary, you understand the reason why we stood from here. We cut this good from our weekly commentary. We cut this good from here. So now, which we stood from that very area. So there are some trades that you don't want as what a swing trader that you don't care about. So let's say you cut another buy from here after. Okay, you cut the buy from here. From here, you know where you are targeting, which is understanding of what liquidity, where you will take a profit and where you what you enter. So now you take what another buy. So these are the major entry you took. Let's say you took another one here. This one, because of the news that happened, you could not catch anything here. Let's say this is the only area you entered. You entered here in this short buy. So these are the setup that you caught on good as what a swing trader. But if it's a scalper, he might catch many from here. He might catch this sell, catch this sell, catch. But one thing about scalper is this: sometimes they can easily make what mistakes. Why? Because after making some mistakes, they will realize the mistake. That is sure. But you always one thing about my strategy is this: you must, if you take let's say 8 setup a day as a scalper, now you win 6, you lost 6, you win 6, you lost 2. After that, you must surely understand, after the player, you must surely understand the reason why you lost it, or the reason why the mistake you made, not the mistake price made. You are the one that made the mistake. So you must surely understand it perfectly. That is that. So that is that for today class. That is that for today class.